Hi everyone. This is the first learning module in my course on corporate finance and valuation. Today we're going to talk about financial statement analysis. So whether you want to work in equity research, investment banking, corporate finance, or even prepare for the CFA examination, understanding financial statements is absolutely essential. Financial statements tells us how a business performs, how profitable it is, how risky it is, and whether it's financially healthy. So by the end of this session, my goal is that you should understand how analysts use financial statements to evaluate companies and make investment decisions. Okay, so let's get started. Why financial statement analysis matters. Every investment decision, lending agreement, and corporate strategy begins with the same foundation, understanding what the numbers say. Financial statements are the language of business, and knowing how to read them separates informed decision makers from everyone else. Investors evaluate past performance and future earnings potential, assess whether a stock is fairly priced relative to its fundamentals. Credit and banks determine a borrower's ability to repay debt. They review liquidity ratio and leverage levels before extending credit. Managers use internal statements for budgeting, performance tracking, and strategic planning. And analysts estimate profitability, growth trajectories, and risk profile. They build valuation models using report financials. So financial statements are the language of business. Every major financial decision starts with understanding the numbers. Okay, so investors analyze statements, determine whether stock is attractive. If they believe the intrinsic value of the stock is higher than what the current market price implies, then they might consider buying the stock. So managers as well use this information to make strategic decisions, and analysts use them to forecast growth and valuation. So one very important point is that revenue growth alone does not mean a company is healthy. Would you invest in a company that's growing revenue 30% per year but burning cash every single quarter? No. A business could grow sales by 30% per year but still lose cash every quarter. That's why analysts needs to go deeper than just headline growth numbers. The major financial statements. There are four major financial statements, and together they provide a complete picture of a company. First, you have the balance sheet, which shows what the company owns and owes at a specific point in time. It's a snapshot at a specific point in time. Second is the income statement, which measures profitability over a period. Third is the cash flow statement, which tracks actual cash inflows and outflows. And finally, the shareholders' equity statement explains change in ownership value over time. The key thing to understand is that these statements are interconnected. Net income flows into retained earnings. Cash flow affects the cash balance. And all four statements work together to tell the company's financial story. So balance sheet shows position of asset liabilities. Income statement reports performance that affects position. Cash flow statement tracks liquidity derived from operations. Shareholders' equity reflects changes driven by prior statements. So balance sheet fundamentals. The balance sheet represents the company's financial position at a specific date. The core accounting equation or the golden accounting equation is that assets should always equal to liabilities plus shareholders' equity. Assets provide future economic benefits to the company. Examples include cash, inventory, receivables, and equipment. Liabilities represent future obligations that the company owes, such as loans or accounts payable. And shareholders' equity represents a residual claim belonging to shareholders after liabilities are subtracted from assets. One important distinction between current items, which are short term, and long term items, which benefit or obligate the company over many years. So we have current assets and then we have long term liabilities and assets. So we have current assets, long term assets, current liabilities, long term liabilities. Assets should always equal liabilities plus shareholders' equity. Assets minus liabilities gives us shareholder equity if we rearrange the equation. So in our example, if you have 500 million in total assets and 300 million in total liabilities, the book value is 200 million. That's the accounting value what shareholders theoretically own. We're going to talk about what market capitalization is, which is shares multiplied by the price of the stock, which differs significantly from the book value, reflecting investors' expectations about the future earnings. Now, understanding enterprise value. So many beginners focus only on market capitalization, but analysts often prefer enterprise value because it captures the true economic value of a business. Market cap only reflects the value of equity. Enterprise value, on the other hand, adjusts for debt and cash. So enterprise value is the value of taking over a company. In a sense, it reflects the true economic cost of owning the entire business, including the debt and the available cash. For example, two companies could both have a market cap of $1 billion, but if one company has significant debt, acquiring that business becomes more expensive. Okay? Because enterprise value is a summation of the market value of equity and debt less cash. Enterprise value is widely used in mergers and acquisitions, valuation comparisons, EV to EBITDA ratio, because it provides a more complete picture of the company's capital structure. So mini EV calculation, if your market cap of 100 mil, total debt of 300, and cash and equivalents of 100 mil, our enterprise value is 1.2 billion. The market cap is all capital providers. Sorry, market cap is only the equity investors' capital, whereas the enterprise value is all capital providers. It ignores debt and cash, captures full capital structure. It's price times shares. This is equity plus debt minus cash. It's used in PE ratio. It's used in EV upon EBITDA, which is a comparable ratio. One important thing is sometimes these two things are combined. This means net debt. This is sometimes referred to as net debt, which is debt minus cash. So income statement basics. The income statement tracks the profitability of a company over time. We usually analyze profitability as a cascade moving from revenue all the way down to net income. Revenue represents the total sales, gross profits, tracks cost of goods sold, and measures production efficiency. Cost of goods sold are the direct costs related to producing products. EBIT focuses on operational profitability. EBITDA adds back depreciation, amortization to approximate operating cash generation. So if I bought a car for $40,000, which I expect to be useful for the next 10 years, and if we use straight line depreciation, which is depreciating the asset by the same amount every single year, the depreciation expense is going to be 40,000 divided by 10, which is going to be $4,000 every year. Is depreciation a cash expense? No. Depreciation is an accounting adjustment. It does not include any cash out. So when we are preparing a cash flow statement which only looks at the cash coming in or going out, we need to add back depreciation because depreciation is a non-cash expense. Finally, net income represents profit available to shareholders after interest and taxes. One of the most closely watched metrics is earnings per share, or EPS, because investors use EPS growth to evaluate a company's performance over time. How do we calculate EPS? It's the net income divided by shares outstanding. So if a company reporting 50 million net income with 25 million shares outstanding, it has an EPS of 2. Investors use EPS trends to gauge a company's earning over time. Let's move to the cash flow statement. One of the most important concepts in finance is that profit does not equal cash flow. A company can report positive net income, but still run out of cash because of working capital issues or heavy investments. The cash flow statement has three sections. Operating cash flow measures cash generated from the core business. Investing cash flow reflects capital expenditures and acquisitions. Financing cash flow captures debt issuance, repayments, dividends, and share buybacks. A key metric that we focus on is called free cash flow, which is the operating cash flow minus capex, which is abbreviated as FCF. So FCF represents the cash a business generates after maintaining and growing its asset base. It's what's available for debt repayment, dividends, and buyback. Okay, so let's look at a real world example. A retailer reports 80 million net income, but inventory builds and slow receivables collection reduce CF to just 10 million. After 40 million in capex, FCF is negative 30 million. Okay, so profit does not equal cash. A company can report positive net income but still run out of cash because of working capital issues. One important thing that we need to internalize is the cash flow statement looks at the cash inflows and outflows. We use the indirect method to calculate the CFO, where we start with the net income and we do certain adjustments. Why is income statement not the same as cash flow statement? Because income statement is prepared on an accrual basis, where we record revenue when earned, not when the cash is received. We record expenses when incurred, not when cash is paid. So there could be significant deviations between the net income and the cash flow statement. And to calculate operating cash flow using the indirect method, we start with the net income, we add back any non-cash charges, we subtract changes in net working capital. Net working capital is a pretty complex topic that I'll be covering in a separate video, but that's sort of the equation. So CFO, using the indirect method, we start with net income, we add back non-cash charges, and we subtract changes in net working capital. So let's move on. This is more like a introductory learning module here. We're going to dive deeper into all these elements. Important profitability ratios. Profitability ratios help analysts evaluate how efficiently a company converts revenue into earnings. Gross margin measures production efficiency again because we subtract the cost of goods sold, which are the direct costs related to producing the goods. Operating margin measures operational efficiency after expenses like SG&A and R&D have been removed. Net margin measures bottom line profitability after all expenses. Revenue or top line, net income is bottom line. Then we have return on assets, which is net income divided by total assets, measure how efficiently management deploys assets to generate profit. An ROI of 10% means the company earns 10 cents for every dollar of assets. Capital-light businesses, software tend to have far higher ROA than capital-intensive ones. The formula is net income divided by shareholders' equity. That's return on equity. That's the formula for return on equity. The primary measure of returns generated from equity holders. Warren Buffett considers sustainably high ROE, 15% plus, a key indicator of what business, a key indicator of a highly effective business in terms of its operations. However, ROE can be inflated by leverage, which is why DuPont Analysis covered next is essentially valuable. So company A has 18% net margin, company B has 6% net margin. But if company B has 3 times the asset turnover, which we'll cover next, it may generate equal or higher ROA. So efficiency can compensate for thinner margins. So liquidity and leverage ratios. Profitability is important, but liquidity and leverage ratios determine financial risk. Liquidity ratios measures whether a company can meet short-term obligations. The current ratio compares current assets to current liabilities, while the quick ratio is more conservative because it excludes inventory. Leverage ratios measures how much debt the company uses. Debt to equity compares debt financing relative to shareholder equity. Debt to capital measures how much of the company's capital structure is financed through debt. Leverage is like a dual edged sword. It can amplify returns during strong periods, but it can also magnify losses during downturns. That's why leveraged companies carry greater financial risk. A company with 100 million equity takes on 200 million in debt. So it has a debt to equity ratio of 2. Investing a total of 300 million at a 50% return, we get 45 million. Without debt, the same equity earns only 15 million. ROE triples, but if returns fall below the cost of debt, losses are equally amplified. So debt is a dual-edged sword. When things are good, it's very valuable. When things are bad, it can really hurt businesses. So high leverage is a risk multiplier in both directions. Then we get on to the valuation ratios. Valuation ratios connect company fundamentals with market expectations. The PE ratio tells how much investors are willing to pay for earnings. The price to book ratio compares market value to accounting value. The PEG ratio adjusts valuation for growth expectation. So it's the PE ratio divided by the growth rate. EV to EBITDA is widely used because it compares business independently of capital structure differences. One very important takeaway is that valuation ratios must always be interpreted in context. A high PE ratio is not automatically expensive if the company has strong future growth prospects. Price to book ratio compares the market value to balance sheet. A PV above 1 implies that market values intangibles and future earnings beyond required assets. Then we have the DuPont analysis, which we use to decompose our return on equity. The formula breaks down ROE into 3 components: profitability, efficiency, and leverage. Okay, this is profitability, efficiency, and leverage. So net profit margin measures profitability, asset turnover measures efficiency, the equity multiplier measures leverage. Two companies can report the same exact ROE, but can achieve it very differently. One company may rely on strong margins, while other relies heavily on debt. That's why analysts use DuPont analysis to understand the quality and sustainability of returns. Okay, net profit margin multiplied with asset turnover multiplied with equity multiplier. So these are the 3 paths to achieve the same 50% ROE. Strategy, margin, turnover, leverage. A premium band has a high margin but a low turnover and moderate leverage. A high volume retailer such as Walmart would have a lower margin but high turnover, moderate leverage. Leverage businesses could have small margin, small turnover but high leverage. Okay. So what are the final takeaways? To conclude, financial statement analysis is not about memorizing formulas. It's about developing analytical judgment. The best analysts understand how all the statements connect together. They compare profits with cash flows, evaluate ratios in context, and think critically about what drives the numbers. Analysts always ask deeper questions. Why are margins changing? Why is inventory increasing? Why is leverage rising? What is management trying to achieve? So these are certain questions that you should ask when you're analyzing financial statements. The best financial analysts don't just read numbers, they understand the business story behind them. Again, accounting is the language of business. So thank you for watching this first learning module. I hope you found it helpful. Feel free to subscribe for more CFA valuation and financial modeling content where I dig deeper into these concepts. Thanks and have a wonderful day.